radio for a really great future. We're talking real money.
Welcome to the show, the podcast eventually that is specifically and scientifically designed to help you become a better investor and thereby have a little more money down the road, particularly in retirement, because that's the biggest thing we save for. Or, proper English, that's the biggest thing for which we save. Hello, everyone. I'm Don McDonald.
Wait, did you write that or did AI write that?
I wrote that.
Okay, just checking.
I'm not letting AI write.
It's kind of erudite for this show.
If AI is going to write for me, then I'll let her speak it.
Actually?
My AI is a her. Yeah, we're going to do that in a future podcast. We got an AI special program coming up eventually. I've been sitting here in my Florida studio watching the weather, and we are surrounded by violent thunderstorms. But apparently the Disney bubble that they built over Celebration has held again and has redirected all the storms around the house. So we don't have to worry about a power outage during the show.
Yes, but downstairs, still got Hurricane Debbie on alert.
Sure.
So
Debbie's always downstairs.
Oh.
And she's listening to the show, so be careful.
Oh, boy. Okay, that's the last thing I'm saying.
Be real careful. You don't want to be on the list.
No, I don't.
She'll come
really
blowing in.
Yeah.
We would love to talk with you about your money issues because that's what we do best, and that's what we like doing most. So call us. 855-935-TALK is our phone number. That's 855-935-8255. There are as many ways to make money as there are people selling ways to make money. And boy, there are a lot of people out there at investment firms, newspapers, magazines, websites, podcasts, all these folks trying to get you to buy their way of making more money from your money. And you're looking for it. You want the simple solution. I want a surefire strategy that will help me beat the market that I can do easily. It's really, really easily. And so a lot of people have gotten enticed by the concept, and this has happened over the course of many years, of picking the highest dividend stocks, looking for those that either raise their dividends regularly or pay the highest dividends, like the old dogs of the Dow theory, where you bought the
bottom
10
performers.
highest yielding dividend-paying stocks in the Dow. You bought those until they dropped out, and then you changed them out. And, it worked sometimes, and then at other times it didn't. But now a strategist at Bank of America decided, the dogs of the Dow was too risky. So you don't pick the 10 best, you pick the next 10.
The 10 above the 10 at the bottom.
Right, because they're not companies in as much trouble. To me, that sounds a little like data mining. Like, let's see. Oh, look, this would have worked if I picked the second quintile instead of the first.
And so instead of just taking the dividends that you're paid, reinvesting in those shares, a total return strategy that we would advocate, which is what we use for our clients. Buying everything, dividends, keep buying more stocks, etc. They're talking about cherry picking and picking those companies that are in the middle that are paying those dividends.
That are not in the highest dividend paying group, but are in the second highest dividend
the middle
group. No, there's a third and a fourth and a fifth.
Oh, okay. Pardon me.
You gotta. There's like 5 of them, so you got to pick the second fifth of.
Then this comes from Bank of America.
Sound complicated to you?
Yeah, it sounds complicated.
And I was looking to try to see what the returns were, and they said,
"Don't worry about that."
Well, no, they said. And here's the date they looked at. They looked at 1930. I don't know why they picked 1930, but if you put $1,000 in the S&P 500 in 1930, it would have grown to 8.6 million through the end of 2024. If you put that same 1,000 in the second quintile of highest yielding stocks, it would have grown to $31 million.
And by the way, if you've taken that same 1,000, give it to Warren Buffett that same year, it ended up with $4 trillion.
He wasn't there in 1930.
Oh, okay.
But I did go to IFA and run the numbers, thanks to our friend Mark Hebner and his gang, from 1930 to 1924 in a 100% U.S. international, buying all the stocks in the world, and you would have been at $28 million with better diversification.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan, one that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Our phone number is 855-935-8255. We're talking about money with you and trying to share with you some simpler, saner ways to manage your money that can help you avoid some really strange advice out there, like the advice from somebody at Bank of America who said, oh, here's a great strategy. Buy the second top yielding 20% of the 50% of the stock market that pays dividends in the U.S. Buy that.
Yeah, remember, when you buy the dividend payers, you eliminate a lot of people that don't.
Right, because about half the stocks pay dividends, about half the U.S. stocks don't. It's roughly 50-50. So you've got about 2,000 stocks that pay dividends. Out of
you've
those,
reduced your diversification there.
Yeah, because out of those, you're only buying the second 20% of them, which is very confusing. It really is. I mean, so you're buying 400 stocks or so. Or you could buy 13,000 stocks, just own the whole market. Which would have been better for you? Well, if you bought the S&P 500 from 1930 to 1924, that's their choice.
You said 1924. You said that before. I think you mean 2024.
2024, yes, that's what I meant.
Okay.
1930 to 2024. You put $1,000 in the S&P 500, you would have grown it to just under $9 million. Pretty good.
Not bad.
If you put it in the total global stock market, you would have grown it to about $28 million.
Ooh.
Even better. Yeah. And had you made up this crazy strategy that didn't even exist in 1930, and you bought the second best quintile of dividend-paying stocks, whoa, you would have made $31 million. Would have. This is data mining at its finest.
Yeah, and again, this always gets back to the keeping things simple. This is confusing. Number 2 on dividends, I still like the total return strategy, reinvesting dividends and interest, and not trying to pick out the best dividend payers, because those tend to be riskier stocks. And as you point out, not everybody's paying them. So you're reducing your diversification, which we'd like to see you pay attention to.
I swear people on Wall Street just sit around and try to think up ideas to make themselves
They're
look
getting
important.
paid to do that, of course.
I know,
sure.
It's so silly. What a I snorted.
They're at the you-know-what, getting a little more
piggies,
of that. Yeah,
little piggies.
Yeah, got it.
855-935-TALK. I'm sorry, this is not my best day. Let's go to Mossy Rock, Washington. I have no idea where that is. Do you know where that is?
Of course I know where that is.
You know where everything is. Paul, welcome to Talking Real Money.
Hi there. How you guys doing today?
Good.
Hey, so my question is, last week we just had a CD mature, and it's $150,000 in that CD, and it was through a national brand bank, and so they said if we do a CD again, the highest rate they got now is 4%. But if we move it into a brokerage fund through them,
of course,
they'll guarantee us 4.9% over 3 years.
In what kind of vehicle?
They just said a brokerage fund. They said they'd handle it. They said they'd guarantee us 4.9% per year.
Sounds like
I'd want to know how that's invested.
Exactly. I mean, is it a CD? It's possible it's a CD, that it's a secondary market CD. And if that's the case, then you're very safe. But it sounds like it may be some other product. And I can tell you there are no other products that a brokerage account, that a broker can sell you that guarantee for any kind of a rate that aren't either one, Treasury securities, or two, bank CDs. Anything else is, if they're guaranteeing it, they're lying.
Can't do it.
They can't do it. They can't guarantee it. They can say it, but even if you're, the only thing I can think of is it might be an annuity. An annuity. What is wrong with my mouth today?
And it is. And then now I'm going through it. Well, they said it's annuity, but but as I'm going through the 56 pages of documents there, it says brokerage.
Yeah, because that's where they sell the annuities, is through their brokerage division. And shame on them. I mean, shame on them, because they know they're going to make more money by selling you way more than they would make with one of their CDs, because their spreads on CDs, their ROI is very, very low. And the best CD you can find out there right now is 4.4%. That's the very best.
For what? How long?
1 year.
Yeah.
Yeah, 1 year.
I would go buy the 4.4 and get over it.
Bear in mind,
think about anything about this.
They can say guarantee because the regulations are so lax, but that's an insurance policy. So it's backed by the full faith and credit of not the U.S. government, by the insurance company. Is an insurance company as safe as the U.S. government? I don't think so.
No.
So
we would not do this.
And I got to tell you, I would not even bank with this bank anymore. Anytime a bank tries to sell you a non-banking product and send you to their broker in a bank, that's the kind of bank I would never want to work with, because
that's even the credit unions do this stuff.
No, you just go with an online bank. I got to say, at least in Bank of America's favor, I have never gone into Bank of America to do any banking work, and they've suggested I go see Merrill Lynch.
You've gone into a bank?
Okay, it's been
no one's gone into a bank in 20 years.
It's been a couple of years. But yes, I've gone into a bank.
I haven't been forever. Anyway, Paul, no, we would not use this product. By the way, how are things in Alaska? I kept meaning to ask him, because Mossy Rock's right down near Alaska, right?
It is. It's about 10 miles away.
Yeah,
How did they get all the way to Alaska from Washington?
Well, they just on Alaska. So it's a beautiful place down there. All kidding aside, you go down to Napa Vine, you turn anyway. So yes, I know where he is.
Napa, that's in California, right?
No, okay, you're getting very confused. Paul, do not listen to your banker. Don't listen to Don. Your life will be better. So there you go.
All right, there you go. Thanks, Paul.
Thanks so much, guys.
Take care.
Thank you. Yeah, but that is a fast brokerage. No, that they said brokerage.
They do that.
They title it that way. It's brokerage. No. That's
and
selling.
By the way, that's not a very good annuity. That rate was really kind of stinky.
Because we had somebody call us last week with something far higher.
Yeah, that's not a very good. Let's see what are fixed annuity rates these days.
Oh, more than that, I would think. I'm trying to remember. I thought somebody called us with something in the 6s last week.
Yeah. Well, okay, there are some, but 6.2.
Okay.
Yeah.
I thought it was 6.3, something like that. So,
the average rate's in the mid 5s, it looks like.
Yeah. Okay.
But again, they're not the same. It's apples and bananas. It's not
even. Yeah.
Yeah, they're very different kinds of fruit, and by the way, the apple will last a long time. Bananas rot very quickly.
But you pointed out something that everyone needs to know, and that is there is not one that I know of. There isn't one bank I know of where I would walk in and the person that they would send me to at a desk there to help me would be a registered investment advisor. They're always broker dealers. Always.
No, not always. Please do not use the word always. It's like using the word guaranteed.
Basically.
There is a smaller bank here in Orlando.
Oh, okay. That actually has an RIA.
That has dimensional.
Okay. That uses dimensional funds.
Yep, in the lobby.
Okay.
That's who they
corrected.
use.
I have yet to see it.
They make less money than the ones with the brokers.
Oh, yeah.
but they're doing a more honorable business, a much more honorable business. And I think we'll see the day when the brokers and the banks go away, but not while they're as lucrative as they are now. 855-935-8255. Call now.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Gonna repeat the phone number because I don't want you to forget to call 855-935-TALK, 855-935-8255. Now, I know where this is. This is down near Renton. Newcastle. Catherine, welcome to the program.
Thank you. I'd like to find out how to read that website that you told us about, advisorinfo.sec.gov.
Oh, sure.
I was curious about a firm called Pure Financial.
Pure, P-U-R-E?
Yeah, I know Pure.
Yeah.
Yes.
I know of them.
I mean,
I can walk you
talk,
through this.
They talk like you guys do, so I was
Wait a minute.
curious.
Wait a minute. No one talks the way we do. Come on. I feel bad for them if
I don't
that's
know.
true.
They-
I really do. Yes, I know who they
do
are.
a lot of joking around, too, on TV.
Out of Mesa, Arizona?
Yeah, they're. I think they're out of Southern California, right?
It
No.
says Mesa.
They're San Diego.
Yeah, San Diego.
Oh,
That's
San
right.
Diego.
Yeah.
Okay, I'm going to look and see if there must be another one. San Diego.
I think they're based in Southern California, but they have other offices. I think that's correct.
Pure
so.
Financial. No, there's two difference. Pure Financial.
Oh,
there's Pure
well, one's an
Financial
RIA.
and Pure Financial Advisors, LLC. Pure Financial Advisors is in San Diego, and I have their ADV that I just pulled up at advisorinfo.sec.gov. And the first thing I look at is the length of it. Ooh, it's not too long. It's only 21 pages. That's a very
plus.
reasonable.
Yep.
That's a plus right there. So if you're looking for a plus, then we go to their fees and compensation section, which is only on page 9, so I don't have to go very far, which is a good thing. And they manage about $6 billion. And they have, let's see, their portfolio management fees range from 40 basis points to 1.6%, which is a little on the high side at the smaller portfolio end. They charge, they're averaging about 1.5% or 1.25%, 1.33% on the first $1 million. And they don't get to 0.5% until $2 million. So they're a little on the high side fee wise.
But they use an approach similar to what we espouse, global diversification. They use mutual funds and exchange traded funds that are diversified. So it is a similar approach. I am aware of who they are. So, but I would not. Again, this is always so tough. But I personally would like to see you never pay more than 1% because 1.6 is fairly
it's on the high
spendy.
side. Yeah,
it's spendy.
It's
So
on the high side. I'm just checking everything else, though. Some of the things I check on, I look for conflicts of interest. I also look for the word insurance anywhere in an ADV because you were asking about how to read it. And you don't want anybody who's licensed to sell securities. And it'll have to say that if we're licensed to sell securities, which could create a conflict of interest, or we're licensed to sell insurance, which could create a conflict. And Pure does not have those conflicts. They are not a registered representative. They're not registered with FINRA. They are not insurance licensed, so they're not selling insurance products. The only glaring negative I can see from them, is that 1.6% at the smaller account sizes.
and they have a podcast, Your Money, Your Wealth. Now our podcast is much better than theirs. I think we can safely say that.
Of course we can.
And theirs only comes out every Tuesday. So we do 5 a week. So we're just saying, we're 5
it's better in
times better.
quantity. Okay.
I don't know. That's the way I look at it.
It is much better quantity wise. You're right.
So I'm sorry.
I don't know how they rate. We'll see how they rate in popularity too. Right?
Well, that's a different matter, but yes.
But yeah, no, they're a reputable firm.
Okay. Well, I appreciate it. Thanks very much.
You're very welcome. Thanks for calling.
But that's a hard website to get yourself through.
What?
The advisor, SEC. Blah, blah,
I know. That's why I like to
ER,
walk. I know. I like to walk people through it, though, because it's such an important resource.
I agree.
It's one of the few ways you can actually vet an advisor, and it's not any fun. It's definitely not fun to do.
This is your money.
It's a lot less fun than reading a prospectus. I mean, it's a lot more fun than reading a prospectus. It's not. Neither are fun. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
All right, I'm too depressed to continue with the show now.
No, what's wrong now?
No, I'm too depressed. I looked during the break. I looked up Your Money, Your Wealth during the break.
They have bigger numbers than we do?
I looked them up during the break.
Yeah.
Yeah, I looked them up on Podchaser.
Uh-oh.
Yeah, under investing, we're number 76.
Yes.
They're number 71.
Well, I think we should sign off then. I think that's.
I mean, it was okay when Stacking Benjamins beat us a little bit. Yeah, it was okay. It's okay because they're more of a millennial podcast. You know,
that's true. More of the crowd.
They're more the young podcast listener crowd. You know, we're a little old, but to get beaten by it. Well, I guess now that I think about it, those guys at Pure are younger than we are too. So.
I hate to break the news to you, really.
I'm really old.
That kind of thing.
Shut up.
Yeah. Trying to compare. Don't compare.
Go to your corner.
Right.
Go to your corner and find a letter from somebody that they sent in at talkingrealmoney.com with a question.
We get more letters than they do.
Maybe.
By the way, the other thing is, I just looked at their pictures. We're better looking than they are, too, by the way.
Sure.
I think so.
I think maybe 20 years ago, maybe.
Well, that's what I'm comparing to 20 years ago. You want this question?
I honestly think that's very subjective, your answer, but that's okay.
That's before this. That was before I found Weight Watchers, right? That just went bankrupt.
Don't even do the Weight Watchers jokes.
No way.
No wait. No wait.
No wait.
Okay.
Well, they would be okay if they were able to, shed their debt as easily as they shed other things, I guess, right?
Geez. All right. He did it.
Sorry. All right.
He did it.
All right. Stacy writes us from Asante, Minnesota.
Asante. Okay. Go.
That's
do it.
With an I. That's with an I, by the way. Hi. We're retired. Congratulations. Wondering if we should transfer money from our traditional IRA, individual retirement account, to a Roth IRA for tax purposes.
That's it? Is that all the information you're giving me?
That's all the information.
Wait, give me that again.
Hi.
Yeah.
We're retired.
And we're wondering. Wait, okay.
Yes, if
all we have is we're retired.
That's it.
Okay.
Wondering if we should transfer money.
No income or anything in there. No.
From our traditional individual retirement account to a Roth IRA for tax purposes.
Given that meager information, I'm going to give my meager answer of then no. I don't know enough, but no.
No, it should be maybe.
No. Again, I know, but no, because I'm psychic. I'm using my psychic
you can
powers.
Tell that it doesn't make sense from a tax standpoint.
Because sometimes brevity gives you more psychic information.
Because I think what she's asking is, for tax reasons, does it make sense to go ahead, move the money from an IRA to a Roth?
Wait, that's exactly what she said, just with different words.
No, she said for...
You just rewrote the sentence with the exact same thought.
No,
you did.
When she says tax purposes, she could be either mean taxes today or taxes later.
Either.
Right.
So
because you're going to pay, if you're going to move money from an IRA to a Roth today, you're going to pay tax.
Do you want?
But later, when you take the money out, you're not going to pay any tax.
Do you want my psychic answer or not?
You already gave your answer.
I didn't. Here's my broader psychic answer.
Yes.
My feeling, my psychic feeling is that this is one of those things where it's like we're retired, we're facing RMDs, and we don't want to give the government any money with those RMDs.
I think you're right.
And so, therefore, if we move it to a Roth, we'll avoid that. No, you won't. You're just going to pay it now instead of later. One way or another, you're going to pay the taxes. And at this point, that's why I said no, because once you're already retired, and particularly if you're drawing money already, it's too late. You just don't have enough time for it to make a difference. You're going to pay taxes.
If you didn't come up with a strategy, then you're right. If you just wake up one day.
Even then, I have a really hard time imagining a strategy that would make it worth paying the taxes now as opposed to paying them later.
Well, except there may be room in your tax bracket if you have the cash to do it, and then you get all these years of tax-free growth. That could happen.
Part of a bigger plan.
Sure, right. I agree.
Absolutely.
But I think it's way overrated as just a way to avoid taxation.
Everybody seems to think that it's just the thing to do. I feel like it's way too trendy.
I think you're right.
Do a Roth conversion. No, you shouldn't necessarily do a Roth conversion. The time to do a Roth conversion, the time when it becomes a no-brainer, is when you've been mistakenly putting money into your pre-tax account when you're young and you're not making that much money and you're in a low tax bracket and you've got 20, 30 years for the money to grow tax-free.
Yeah, that's good.
Then my answer would be, if you can afford to pay the taxes out of other money, do it when you're young. But when you get older, the benefit is negligible.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Yeah, I mean, we're talking real money, but we're no your money, your wealth, apparently.
You're not going to get over this one for a while. Does anyone else want to call us with a podcast that they think is better than ours? Please feel free to do that.
855-935-TALK is the number to call with those better podcasts and make Don feel bad all weekend. 855-935-8255. I'm in Florida, and our next caller's also in Florida. Derek,
really?
Is it Derek? I'm sorry, I messed up. Derek?
Yep, it's Derek.
Hey, Derek, welcome to the show.
How you guys doing?
Good, thank you.
Hey, appreciate
You must
it.
be from northern Florida.
You can tell by the accent.
I'm from basically Lower Alabama.
Lower Alabama. I was going to say
Lower Alabama.
Because us down here in the other part of Florida, we don't have accents.
Sinkhole Central.
We're all from somewhere
else.
We're not from Florida.
Good point.
What's up?
Oh yeah, I won't hold it against you.
I know.
That got a laundry list of things.
Okay, go.
Start with the first one.
Oh, good idea.
Well, I wanted to thank you guys for been a long time listener. I had a life insurance guy that was a friend of mine growing up, and when I changed jobs years ago, we basically swapped my retirement over from the employer I was in into those accounts, and ended up in some high rated products, and I guess like a hodgepodge of what you would call it. So listening to y'all's show kind of got me into pulling it out of that and going to like a Vanguard low fee account. And
how's the friendship?
I wanted to ask,
how's the friendship?
The hard thing was I went to church with him my whole life.
Yeah,
boy. It was a struggle to get out of that. So finally got out of that. Hadn't been able to really talk to the guy since. So
I hate that this is why
I know.
This is why they say don't mix business and pleasure. I mean, really, it's so.
Yeah, never again.
Yeah. Anyway, go ahead. I'm sorry, Tom interrupted.
Please.
Oh no, yeah. So basically, I'm a government employee. I've got a TSP with a life, like a LifePath 2050 fund. What I've got with my Vanguard is somewhere around $40,000, and I'm trying to fix the mess of what it is, because everything I pulled out was in a bunch of mutual funds. And so is it as simple as like transferring those funds into like a LifePath? Because I've started to put into like one of those LifePath funds in Vanguard as well, because it had like a much lower rate? Or would I be better off to put in like a just VT and then the BND funds that you guys have on your website? Kind of where I know that's a mixed question, but that's kind of
no. That depends how much work you want to do. So if you take a LifePath fund, they do the adjusting for you, right? They're going to say in 20 years, what'd you say, 2050? 25 years, you're going to retire. Therefore, we're going to say you should be 75% in stocks or 80% in stocks, 20% in bonds. And then they're going to reduce that exposure to stocks here in the next 25 years, because as you get closer to retirement, and I believe we looked at one of the LifePath funds, life cycle, those at retirement, I think they get to be 50-50, for example.
Vanguard's Retirement 2050 fund, now, which is by 8 basis points for this fund. It's just,
it's just ridiculously cheap.
These things can be.
Yeah.
It is currently. Really?
That's the northern.
It's about 90,
Arizona.
It's about
90-10. 90-10. So it's very aggressive. Very aggressive. But back to your question, Derek, and thank you, by the way, for your kind compliment, which comes in handy because you can see Don is still depressed by learning of our fate. So the reality is, if you're okay with working a little harder, then you take 90% of the money, you put it in VT, and 10% in bonds, but you're the one who's going to have to do the work. You're going to have to rebalance that from time to time as different things go up or down, or you add money, or et cetera, et cetera. So to me, it's simply a matter of how hard you want to work. I don't think there's going to be a lot of difference between one or the other in terms of returns.
They're basically the same portfolio, Tom. I mean, the Vanguard total, or the Target Retirement 2050 fund, is invested in Vanguard's total stock market index, Vanguard's total international stock market index, Vanguard's total bond market index, and Vanguard's total international bond index, which means it actually gives you a little bit better diversification than having VT and BND at slightly higher expense ratio of
not much
3 basis points higher.
Yeah, it's not going to change things. So, I mean, if it was my money, I'd probably do the latter. I'd probably go ahead and build it yourself with that in mind.
See, I do the opposite.
Okay.
It's going to be good either way.
Contrary today, aren't we? I would do.
Remember, you were talking about your friend a moment ago. You haven't talked to in all those years, so we're working our way to that here. It's coming.
Well, y'all been together 40 years now?
Exactly. So there you go. Please.
Yes,
it is. I think it is
35 years or something.
Yeah, it's a long time. So.
Well, I figure this relationship will deteriorate to nothing right about the time we both die, which works out perfectly.
Close
enough. I've been tracking it. I'm charting it.
37 years if you're playing along from home. I just looked it up.
Oh, wow.
Coming up on 40. So it's probably the longest relationship I've ever had, actually. That's still
other than family. It's the longest relationship.
Yeah. I know. So I don't know if that's good or bad. I have to think that through a little bit.
I've known you and my wife for the same amount of time, though. So I can't. Yeah.
Anyway. Let's leave it at that.
Anything else on your mind, sir?
No, just wanted to tell you guys, I appreciate the podcast. 10 years ago, I was ignorant to the fees and all the things you guys talk about, and slowly started to work my way to wanting to get into a lower expense with just about pretty much the same, if not better, earnings on it. So I just appreciate y'all's education. It's not something like y'all talk about. It's not something that they teach in school. That should be.
No, it should be, but they never will, because there's just too much vested interest in supporting the contrary. And so now that you're done, now that you've learned everything, are you just going to go start listening to Your Money, Your Wealth instead?
You can't get over it. Listen, Derek, next time you need to break up another friendship, you give us a call. We're here to help. So feel free to ring us up. So
maybe next time I'll let you guys do the call for me.
All right. Enjoy the panhandle.
Yeah, exactly. Thank you.
Yeah, y'all have a good day.
All right, take care, sir. Bye-bye. It's so funny. Florida is such a strange state. If you go down to the very southern end of Florida, toward Miami, Boca, West Palm, down there, you are in the Northeast. You're totally
because everybody's transplanted.
Everybody's
from
got
the
like a
Northeast
New York accent.
Now wait, except Messi isn't Messi in Florida. He's
just
from the South, isn't he? Deep South.
Yeah, but he was
South
rented.
America.
He was rented.
Oh, okay. He's a rental, really a resident.
He was a rental.
Makes sense.
So you got that, and then you get to Central Florida, And
Sure.
it sounds like you're in the Midwest.
It's like a Mickey Mouse operation in the middle.
He's trying so hard to be funny. And then you get up to the panhandle of Florida, and it sounds like everybody's from like Alabama or Georgia.
What do you call it? Deep Alabama or something?
Lower Alabama.
Lower Alabama.
Lower Alabama, which it actually used to be. It used to be part of Alabama. But it's,
are you taking a speech lesson after this, I hope, or something?
Well, we could just get really, really Southern. And
hopefully the editor out on this one.
I'm not. I'm not taking the editor to it. The
Okay.
podcast audience deserves the raw audio, just like the live audience gets. Right?
Sorry. Yeah. I'm sorry. Yeah.
I'm just sorry that your money, your wealth is at 71 and we're at 76.
Please tell your friends and family.
Okay, here's what I'm going to ask before the break. Get more people to listen to us. Make Don feel better. My birthday's in June. For my birthday, please give me a better rating so that we go above your money, your wealth by June. That's all I ask. I want nothing more, just that.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And before we go, there are a couple of people out there that we really we know kind of.
Wait, Catherine just wrote us. She's sad that she depressed you. Catherine, it's okay.
It's okay. It's
about the pure financial thing. It's all right.
It's a bit. It's a bit. I'm okay.
He's fine.
I'm not really crying. That was just acting. That was acting. I was just acting, Catherine. I was pretending to cry.
He's okay. We'll get over it.
A couple of people we really respect and know, and we're not like great buddies, but Jason Zweig is one of them. He just wrote a column about the other one, a guy by the name of Jonathan Clements. I was honored to have written a blurb for one of his books, and Jonathan is terminal. He is going to die within probably the next year or so or less, and
says he's already in overtime. He's past where he's supposed to live.
He's in overtime, and it's really he set something up that we thought was kind of cool.
I love it. He's setting up these Roth IRA for kids. Now, I'm a little unclear as to whether there's going to be research to see how this all works out or not.
Yes, that's what it is. Part of it was to help create some research into what if you gave underprivileged kids who don't have a lot of money, you gave them a free $1,000 Roth IRA.
Now, this isn't money they can go spend. This is money for their future.
Well, but technically they can, and that's what the study is all about.
Sure.
To see what happens if someone is given the gift of a potential retirement and what they do with that money. Do they keep it? Do they keep it invested? Because
do they add to it?
Do they add to it? $1,000 with a few $100s every year added to it over a lifetime is going to be a substantial amount of money, or should be. And so not only is he setting up these Roth IRAs for these kids in the Boston area, I believe.
Yeah, I think it is.
But he was also setting up a study to follow the money, to follow them, and to see what happens with it. And, that's one of those kind of cool legacies that changes people's futures, that it has the potential to do so.
By the way, if you want to help, it's called the Jonathan Clements Getting Going on Savings Initiative, because one of his things is just start. Do something. Yeah. I mean, he's been saying that for 30 years. And the money contributes to a Roth individual retirement account. It says it's not tax deductible.
It's not.
Okay.
Because he probably didn't establish a 501c3.
Yeah. Anyway, so I'm trying to find the URL here, but I think you go to the Bogle Center, or it says JPAL. I'm not sure. I should have known that. But at any rate, if you type in Jonathan Clements Roth IRA, I'm sure it comes up on the interweb. But this is a great legacy.
1 minute.
Work as somebody we've respected for, as you said, decades. Wrote for the Wall Street Journal for an extended period of time, and somebody who's really been interested in financial industry. And this is a great way to leave something behind after you're gone. So,
it's actually a little bit. You can go to the John C. Bogle Center for Financial Literacy is probably the best place to find it, which is boglecenter.net.
Bogle, B-O-G-L-E,
Center.net /getting going.
Okay.
And
so help if you'd like.
Yeah, it's a brand new thing, but it's really interesting. Thank you all for being a part of the show. Please, if you have questions for us, remember you can call us on Saturdays at 855-935-TALK, or you can send your questions in at talkingrealmoney.com. Also at talkingrealmoney.com, if you'd like to meet with one of our lovely advisors, 100% fiduciary advisors with no sales pitch, seriously, and for free, just go to the same place and hit Meet an Advisor.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.